So let's conclude our discussion of the cost of financing, right? The weighted average cost of capital. So let's start talking about the weights, right? So how do we determine how we finance our products? Well, we'll discuss this in some later chapters when we talk about capital structure. But let's just assume that the company has decided to finance in this structure below here, where it's 30% debt, 10% preferred stock, and 60% equity. That is what we are striving to finance. Now, this could be different from what our book value says. These are market weights. So if we find the market value of our capital structure, we'll talk about this in a second. Find the market value. Let's say that this is what we come up with, 30, 10, and 60. Now, what if we say, well, we really would like to increase some of our debt. So maybe moving forward, because we're thinking about gathering new money, maybe we want to gather 40% debt, 10% preferred, and 50% stock. So the number we choose has two parts to it. We want to start thinking about market values, but we also want to incorporate some strategy of how we want to finance moving forward. If we don't know the targets, it's better to use market values than current book values, right? We talked about it. What if you don't know the value of debt, right? Well, usually it's pretty reasonable that the book value of debt and the market value of debt is usually pretty close, unless we've had some very volatile risk changes in the company. So let's talk about the weights. So we have three kinds of securities, right? Bonds, preferred stock, common stock. We know what their prices are, and we know how many we've issued. So we can calculate the values, right? 1153 times 70,000 is the market value of our debt. So again, we do those calculations, and in that spreadsheet we had before, we can input those calculations. So this tells us that according to our market value, we're 31% debt, 9.2% preferred, and 59% equity. That's what our market value is. So let's assume this is what we want to do. We're going to follow this strategy. So to find the weighted average cost of capital, we multiply across, right? So it's the weight, 30% debt, times the after-tax cost of debt, plus 10% times 9%, 6%, 60% times 12.8. So again, this is just rough, but in general, those are the ratios that we're using. Now, this number reflects what we refer to as the first tier of financing. When the company first starts gathering money, it uses this capital structure and the cheapest sources of funds. Now, when it exhausts these cheaper sources, to get more money, obviously, it's going to have to get more expensive funds. This was what we might refer to as a second tier, if you will. And as we continue to gather funds, the cost of sources may also increase, like debt could also increase. So let's see how this might work. The very first structure, again, if you notice, I adjusted these just a little bit to be more accurate here in our weights. But you can see that the first tier says, as we first start gathering money, we're going to gather at 10.82%. That's the weighted average. Now, somewhere, we're going to run out of retained earnings. When we run out of retained earnings, we're going to substitute the retained earnings with the cost of new. You see, it's higher. So now the weighted average cost goes up. So We have a first tier here and we have a second tier. But if we could actually add what we refer to as breakpoints, right? When will the cost of financing go up? So let's say we talk to our bond holders, our investment bankers. They say, look, you can get $50 million, but after $50 million of debt, the cost is going to go up from 7.5%. It's going to go to 8.5%. Cost is going to go up. Retained earnings. We estimate that in the future, next year, $70 million is what we're going to have in retained earnings. So what this means is if we gather more than 70 million in equity, the cost is going to go up. There's going to be a step. So the first tier again is that 10.82%. Now down here you see there's a break point. This means there's no debt, right? The debt didn't break, but equity broke. So at this point, 10.92% is what the cost is. So it's from 0 to $118 million of funds, it's going to cost 10.82%. From 118 million to 157 million, it's going to cost 10.92%. And if we gather $50 million of debt, that's going to break at 157 million. So over 157 million of funds that we gather, it's going to cost us 11.24%. So what factors influence this? There's some that are controllable and some that are not. Certainly market conditions, the market risk premium, tax rates in general. We can't control those, so we obviously need to think about what might happen with those. But again, that's a forecast. But there are some controllable factors. We can change our capital structure. We can change our dividend policy. We can change our investment policy, right? So if we change and we start thinking about projects that are riskier, that's going to have an influence on the returns that our investors want, which in turn has an influence on what it's going to cost us to finance those projects. So is a firm's weighted average cost of capital correct for each of its divisions? Well, no, right? So the number we calculated is the average for the company, but different divisions could have different risk. Different divisions could have different ways of financing. Their structure could be different. So we need to adjust based on the division needs. If we're thinking about risk, we need to look at what would this cost of capital be if it was a standalone firm, right? So we're going to have to estimate some things. We're going to need to think about the division's beta, the cost of debt to the division based on that riskiness and its capital structure. What we can do is something referred to, we've talked about this in previous videos, something called the pure play method. So we're going to estimate beta for a division or a product. So we could find several publicly traded companies, right? We could use the average of those betas as a proxy for our company. Again, it's very hard to find those kinds of companies, but we can use this process to at least estimate the beta for a division. We could also run some regression between projects ROA and the S&P 500 index. Accounting betas are kind of correlated with the market betas, about 0.5 to 0.6, so they're pretty closely correlated. But normally we just can't get any data on new projects ROAs. So it's difficult to gather this data moving forward on projects. But if we have a beta for the division, 1.7, here's the weights in our division, our costs. Again, we can calculate from this data, we can calculate the weighted average cost of capital for this division. So in this case, it's 15.12%. It's different than the weighted average cost of capital of the entire company. This reflects higher risk within this division than the overall risk of the entire company, which is why it has a higher rate of return or higher cost, which also relates to return. There are three basic types of risk when we think about projects: standalone risk, corporate risk, and market risk. So standalone risk is the easiest to calculate. We'll talk about this in some later videos. Market risk, theoretically, it's the best in most situations. But creditors, customers, and suppliers, they're all really more afflicted by corporate risk. So corporate risk is also the most relevant risk when we're thinking about gathering funds for projects. So a project-specific risk-adjusted cost of capital is something we need to consider. We start with the divisional cost of capital, and then we use some judgment. We may scale the cost of capital up or down based on the individual project relative to the divisional cost of capital. So in general, what are the mistakes? If we've talked about some ways to calculate weighted average cost of capital. We've talked about the factors that affect those costs. We've talked about how we might need to adjust that within the division, right? Based on the project within that division. So let's talk about what are the mistakes we need to avoid. There are four basic mistakes. So let's go through them individually. Number one, using current versus historical cost of debt, right? We don't want to use the coupon rate on existing debt because that represents the cost of past debt. We want to use the current interest rates on new debt, right? We're gathering new money. We want to use new numbers, not old numbers. We need to worry about the market risk premium, right? So when we're estimating the risk premium for the CAPM approach, we don't want to just subtract the current long-term debt or long-term rate from the historical average return on stocks, right? So if the historical return on stocks has been 12.2 and inflation drives the current risk-free to 10, that deduction there, 2.2%, is not the risk premium because the 12.2, that historical cost on stocks, is now different, right? Because the rate of return for stocks will also go up as inflation goes up. What about weights? Again, we want to use target capital structure to determine the weights. These are, when we say target, we say this is strategy, right? What does management want its capital structure to look like? So once we know what the target capital structure is, we now have to use market values. We want to use the market values to reflect new money. And we've talked about how you might adjust those things. Now, finally, right, there are some short-term factors, right? Accounts payable, accruals, deferred taxes. They're not sources of funding that come from investors. So they're not included. They are, first of all, they are short-term things, right? So any use of short-term financing in this capital structure is just incorrect, right? We want to we're going to take care of those things in other places, right? We're going to do those. We're going to talk about how we adjust in those costs, but they're not part of the long-term capital structure, long-term financing needs of the company. So again, that's the end of cost of capital. Hope you enjoyed it. See you next time.